Fed. But our next guest is focusing on this recent run-up in AI stocks that look, at this point, according to her, overextended, investors needing to be ready for a tough second half of the year. Erin Gibbs is senior partner and CIO at Main Street Asset Management. Erin, always great to have you with us. And of course, it really doesn't help in the second half that we're starting with June, historically the second worst month after September.
Yes. So there is some of that potential June gloom that I think we could face, particularly if we don't get that pause from the Fed. But there are a couple of reasons that I'm a little concerned about the stock market right here. One, I know this has been talked about a lot, but obviously a lot of the appreciation that we've seen in the broader indices has really come from just a few stocks, just particularly the AI and some of the mega cap stocks. And so when you don't have that breadth, you don't have that large participation, that ultimately means that there's some underlying weakness there because not all stocks are going well. And we're also seeing a lot of revisions just in earnings forecasts for the second half of the year. So I think we're really ripe for some type of pullback, markets sort of coming down, and any of these high betas, if anything disappoints, obviously we know that these retail investors act somewhat, emotionally or have produce big swings, big beta that could pull those stocks back and then ultimately pull the index back. So I think just a little cautiousness, a little hesitancy as we get a clearer idea of how the Fed's going to act and what we might see in the second half.
That's really been difficult to gauge, right? The uncertainty over the Fed, now that we're not even talking about a pause, we're talking about a skip, what that really means when the data also seems to be pretty conflicting.
Right, because we're getting, obviously, the CPI is coming down, or it has been coming down for the past 9 months. We're starting the M2, obviously the money supply. That's a really big factor when looking at inflation impacts. But then we still have this, record unemployment levels where everybody has a job, and obviously that can continue to persist. Given persistent inflation, if we see those wage increases. So I think it's going to be really down to the wire. I know the Fed likes to say they don't really use the CPI, but the CPI for May obviously comes out on the first day of their meetings. I think ultimately they are probably going to look at that. And so whether the next job reports come out and what we see in the next couple of weeks, it might really be just down to that very first day of the meeting.
Erin, we still have a very inverted yield curve. It's been saying recession for quite some time now. What's your view on if and when it happens and how deep it might be?
So I do believe that it's still, absolutely a very possibility. It's a strong possibility, even with the strong inflation environment or unemployment environment. I think that we could see it, particularly looking at profitability and GDP growth. And ultimately just the impacts the higher interest rates could have on the real estate market and how that might trickle into other industries. And so I think we're definitely looking at more a fourth quarter event. I don't think it'll necessarily just immediately happen in the third. And certainly, obviously, a recession means we need to have 2 consecutive quarters, so it'll be something more likely where we really see it kick in the first half of 2024. When looking at investments, I do want to be very aware of recession risk, but also being aware that the U.S. stock market tends to bottom out early in the recession period. It tends to be very forward-looking, and so we might see, an early bottom in the market before we even, before that recession is actually over.
We're running a story on Bloomberg today as well about bankruptcies rising in the U.S. Is this something you're watching?
Absolutely, and creditworthiness, abilities to get loans. So one of the factors that I look at just when selecting stocks is free cash flow yield and the ability to generate profits. So companies that have really strong cash flows, they don't necessarily have to go to the debt world. They're able to pay off their debt payments. They're able to raise dividends. That is one of those qualities that I look at, particularly when we're looking at a tightening credit cycle and obviously even any potential for recession.
Do you go overseas? I mean, especially given that there was so much expectation of the China reopening and that seems to be faltering now?
That's been a pullback. I was more heavily invested in Europe earlier in the year. that because of the China faltering, sort of lessened hopes on the reopening trade, lessening hopes on tourism, that has been a pullback. I think we're looking at even more reduced opportunities within Europe. And so right now, I still have a large amount in cash, just because there are so many risks. But certainly, it is looking less attractive.
I don't think you're the only one who's holding cash under the mattress at this point. Erin Gibbs joining us here in the New York studio, senior partner and CIO at Main Street Asset Management. Let's now get to